Silver investors have called foul on price manipulation, but is this just a big conspiracy theory, or is there actually evidence to support this? It's common to hear investors and analysts blame bullion banks for capping the price of gold and silver in the short term, but could there be another explanation to this, such as mining companies hedging? And there is some merit to this, because if you are a big silver mining company, then you will use forward contracts to hedge your future output. And you're going to do this at prices where there is a technical resistance or other key areas in the silver market. So should the spot silver price get to a certain point, it means the futures prices are probably at a key resistance level as well, meaning there's going to be more selling activity. Whilst this could explain away some of the selling at certain prices, there have been high-profile silver rigging cases which have been made public and settled in court. The example that I want to share with you is the Deutsche Bank silver rigging scandal of 2014. Then we will take a look at some of the mechanics behind the rigging of the silver price. J. Scott Nicholson was a US-based silver trader who believed he had incurred financial losses due to bullion banks rigging the price of silver. This case was eventually settled in court by a Deutsche Bank who agreed a settlement of $38 million. As part of this, they also handed over 350,000 documents which showed the chats between their traders and traders at other bullion banks. This also included 75 audio files. There was chat logs which showed clearly how Deutsche Bank traders and other traders from different banks conspired to manipulate the price of silver. As an example, UBS and Deutsche Bank traders agreed to short silver at exactly 11 AM, UBS confirming they would try to recruit a Barclays trader to join the manipulation. The court transcript showing what the traders were saying to one another can be downloaded on the link in the description. But why do bullion banks rig the price of silver? There are a few reasons to why bullion banks rig the price of silver. Firstly, if they can manipulate the silver price lower by selling a load of paper silver into the futures market, it allows them to buy at a lower price and then ride the price back up to make larger profits. If you recognise the mechanics of electric or contract for difference account trading, you will know that the platform providers profit from their clients losing trades. If I open a trading account and buy 10 contracts of silver, that trade is contained. I'm not actually buying in the market. It's just a position managed internally by the platform provider or broker. Therefore, if I make a loss, that's the broker's profit. When I buy, by default, the broker is short. When it comes to leveraged CFD trading, it's often very obvious by the chart where the traders will put their stop losses. And so if you are a big bank and you have a platform for CFD trading, but you're also able to trade actively in the market, if we take the example of buying silver, where the silver prices come down to a support level, a lot of your clients are using their CFD accounts to go long silver, you could dump a load of silver futures contracts, push the price below the technical support, you're able to see where the stop losses are, so you push silver prices down enough, stop your clients out, and then you buy the silver back and the silver price goes up. The transcript of the Deutsche Bank evidence shows the traders in question calling themselves stop busters as a reference to pushing the spot silver price into areas where they can see their clients have stop loss orders. There is another widely accepted method of manipulation in commodity prices, and it's called pinning, and it links to options. So let's take a look at what options are and how this pinning strategy works. The options that you'll be able to see are call options, which is the right to buy. A call option gives you the right to buy something like silver at a set price by a set date. You buy a call option when you think the price will go up. For example, you buy a call option to buy silver at $25 per ounce. If silver goes to $30 per ounce, you can still buy it at $25 per ounce and sell immediately for a profit. A put option gives you the right to sell something at a set price by a set date. You buy a put when you think the price will go down. For example, you buy a put option to sell silver at $25 per ounce. If silver drops to $20, you can still sell it for $25 per ounce and profit. Let's take a look at this in a scenario so that you can really understand how this whole mechanism works and why it's so profitable for a bullion bank to manipulate the price of silver going into options expiry. Let's say it's the final week before options expiry. There are lots of call options at the $26 per ounce strike price, meaning if silver closes above $26, these options are in the money. A bullion bank has sold many of these call options, so they're the counterparty. A short position in silver, they may benefit if the price falls. So their goal is to keep silver below $26 per ounce until the options expire. So those call options expire worthless, and they are able to keep the premium from selling the calls and profit from the short silver position. So this is how they pin the price. Silver is trading at $26.10 2 days before expiry, which is not good for the bullion bank. They flood the COMEX futures market with large sell orders, which is paper silver. This creates artificial downward pressure on the price. Other traders see the drop, panic sell, or get stop loss triggered. Price drops further, and by the day of expiry, silver is back to $25.90 per ounce. The outcome of this scenario is that all of those $26 per ounce silver call options expire worthless. So the bullion bank gets to keep the premium because they charge a premium when they sell these options. They also profit from their short position, and they're able to buy the silver back at a lower price level. So the bullion banks are effectively pinning the price of silver just below the strike price where these options would have paid out otherwise. Investors that watch silver and gold prices closely might notice around the options expiry dates that the price of silver or gold might go down, which is against the immediate trend. And it might look quite suspicious. It's probably pinning that's at play. The bullion banks are trying to push the prices down so that the options that they've sold expire worthless. When it comes to gold and silver manipulation, there's many established analysts in the industry who believe that the manipulation is much bigger than a single bullion bank or a trading desk. They believe that the orders are coming from the very top, which is the US government and also Federal Reserve, because gold and silver are a competitor to the US dollar, and it's gold and silver that often threaten the US dollar's safe haven status. Rising gold prices, and by extension rising silver prices, can be seen as an inflation signal, and so keeping the cap on the gold price and the silver price can help restore faith in fiat currencies such as the US dollar. So many people, and there is merit to this, suggest that the central banks and the governments don't want the price of gold or silver to go up by too much because it might reduce faith in currencies such as the US dollar. It's not actually the central banks themselves that are openly manipulating the silver or gold prices. It's the bullion banks that are doing this on behalf of the central banks. And this is actually a massive topic in precious metals, and that's why Auronum will be publishing over the next coming weeks, on the link in the description, a lot of cases where there's been evidence in the public domain of gold and silver price manipulation. So make sure you click on the link in the description to see some of the evidence that's been made public on manipulating the gold price and also silver.